Hi, everyone. Welcome to Market Outlook, Trends, Risk Events and Trade Setups, brought to you by Vantage Markets. This is a weekly webinar where we focus on the key events and themes, both fundamental and technical, driving markets at the moment. Whilst I just let you have a look at the quick disclaimer, we'll just run through what we hope to get through in the next 30 to 40 minutes. We'll follow the usual format. There's quite a few of you guys on here today, so that's great to see, and quite a few new people as well. So welcome to the weekly webinar. Yeah, we'll follow the normal format. So we'll look at how markets are shaping up currently, what we're looking forward to this week. And then we'll look at just a theme around stock market breadth, actually, which we've been talking about for a while. And just giving you a couple of stats on that before then looking at some equities, US equities, and some of the technicals around those. We'll then do a quick review of last week's main events. So that's non-farm payroll from Friday, of course, and then Thursday's Eurozone inflation data. But we'll look at as well what's happening concerning the dollar this week. A few bits of second tier data, really. We'll look at the DXY index, which is the dollar index, mapping against 6 of its biggest trading partners. And then we'll look at, as I say, the Eurozone inflation print and some of the Eurozone data out of especially Germany this week, which could be of interest for the euro dollar, as well as looking at technicals around that major. Also then this week, we'll look at the main events, which we see as probably the 2 main central bank meetings. So that's the RBA overnight tonight, really UK time at least, and then the Bank of Canada meeting Wednesday afternoon UK time. Interesting calls for both of those banks, central banks, whether they potentially hike rates, which is kind of not priced at the moment, but a potentially surprise move is possible on both those central bank meetings, actually. So we'll look at the Aussie dollar to do with the RBA, of course, and then the CAD, so loonie, the Canadian dollar against the dollar as well, and those technicals around that. Okay, first up for us then is, well, I should say actually before we get to it, please do ask any questions if you do have any along the way. We'll try to answer those as we go, or certainly by the end of the webinar. But if you have any questions at all, however small, however big, about what we're looking at or what you're looking at as well, potentially any trade setups or any fundamentals that you want to talk about and discuss, then please do right away in the chat box, which you can see at the bottom probably of your screen. And we'll try to get through some of those questions and hopefully answers for those questions. Markets this week then mainly generally quite quiet. The main news has been actually from Saudi Arabia. They announced a 1 million barrel per day production cut from July, and all other OPEC plus producers agreed to extend earlier cuts through to the end of 2024. So interesting. Oil is, well, has been up around 2 to 3%. Is now back sort of around 1.5% gains. Otherwise, relatively quiet start of the week. Stocks marginally in the green, with not much in the way of weekend news flow for equity markets, really, to guide prices after Friday's pretty solid session, actually. We did get the final release of the Eurozone services PMIs, which were revised lower. And Asia is mostly positive amid momentum from those non-farm payroll gains from Wall Street, and then also stronger PMI data out of China first thing today. I think noticeably probably over in Asia, the Nikkei 225, that climbed above 32,000 for the first time since 1980. So decent markets out there. For the currency markets, US dollar maintains bullish momentum from non-farm payrolls, and support was also underpinned by weakness in the yen and sterling, especially. Interesting moving cable. In fact, if we just pull that up, I've got a stock chart here, but if you just bear with me 1 second, I'll just pull up cable. That's the weakest major currency on the day. Just bear with me 1 sec. You can see that here. So this is the cable chart. So sterling against dollar Yeah, just the weakest currency on the day, really. Major currency on the day, sterling, retreating really below 124. You can see here, below also 124.47, which is sort of the line we've had from way back in January as being where we've sort of pivoted around it, and we're doing that, it looks like, again. But we're below that now after a push up last Thursday, where it looked as though we were holding above that. And then obviously Friday's strength in the dollar pushed cable lower. So interesting move here. Can't really see that many reasons for it. Actually, it's just kind of a corrective move rather than any fundamentals, given actually that there were marginal beats in UK services and composite PMIs. Okay, so going forward this week, as I said, we get kind of second tier US data. We get ISM services data out of the US today. We also get the weekly jobless claims data on Thursday. That will be on tap really to see how divergent Fed policymakers could get at the June meeting, as a pause now remains priced in for now. So that's a pause by the FOMC in June, whereas July, and we'll look at this in detail shortly, July really priced for another 25 basis point hike. Meanwhile, Eurozone recession concerns could pick up if German data this week continues to disappoint, and that suggests potential Eurodollar downside. China has a deluge of data. We saw some of that this morning. From trade to inflation to credit supply, and sentiment may be starting to trough after the PMIs surprised on the upside last week. And then, of course, we've got those Bank of Canada and RBA meetings coming up in the next 48 hours or so. As I said, sort of hawkish commentaries remain probably likely, potential for a hike, certainly. If not at this week, then certainly at the next meeting. I just said I'd point out some stock market breadth, actually, and if you just bear with me 1 second. Got a chart here just showing us really US stocks actually at the moment. We pointed this out over the last few weeks, last couple of months, really, this outperformance of the NASDAQ. So you can see the pink line there. This is rebased, as you can see, to 100, going back to sort of June 2022. So you can see the thick blue line is the S&P 500. So that's the benchmark, broader blue chip index. And then the NASDAQ is obviously full of tech-laden companies. It is growth tech companies mainly. Predominantly dominates the NASDAQ, and certainly the mega caps as well in there. So you can see really the S&P 500 slightly lagging the NASDAQ 1 composite now. That is, you can see the outperformance there, sort of underperformance into the start of this year, and then outperformance as we move through sort of springtime this year in the NASDAQ. It's this stock market breadth really, though, which still remains weak. I think only about 40% of the S&P 500 index constituents are trading above their 200-day simple moving average, and concentration has increased too. So the 5 largest companies now make up nearly a quarter of the S&P 500's performance. And as we've said before, this year's gains have primarily been driven by those tech mega cap companies. If you think about it year to date, the S&P 500 is up over 12%, but if you equally weight that index, then it's up only 1.5%. So something to bear in mind there with this continued outperformance of the NASDAQ. We'll look at the technicals shortly. As for US stocks in general, they advanced decent gains on Friday. S&P 500 recorded actually its biggest one-day rise since April, after traders really cheered the latest jobs report and, of course, the passage finally of the debt ceiling bill in the Senate. S&P 500 rose 1.5%, its highest level since August, actually, marking its 3rd straight week of gains with a 1.8% increase. We just pull up the chart actually here. So we'll just go to the weekly S&P 500. So just before we get to the technicals, decent gains. In the S&P 500, the NASDAQ, tech-heavy NASDAQ added 1.1% to a level last reached, hit a level last reached in April 2022. Its weekly increase actually was 2%, brought the index its 6th consecutive week of gains. And just before we get to the technicals, actually, also like to point out the VIX. So that's a measure of stock market volatility for the S&P 500 over the next 30 days, often referred to as Wall Street's fear gauge. That fell to, well, 14.6, so its lowest close since February 2020. Always kind of think of the VIX as a kind of contrarian indicator, actually. So when there's very quiet, very low numbers on there, then potentially we have, well, the potential for sharp moves going forward. But at the moment, very, very low closes in Wall Street's fear gauge. As for the S&P 500, you can see the technicals here, the weekly. 4,200 has been a key zone for technicals for many watching that sort of zone. It sort of tallies with the January high at 4,195, also tallies with now the 100-week moving average. This is this thick gray line here. The 100-week moving average is at 41.99. So sort of 4,200 zone has been key. It's capped resistance. You can see over the last few weeks for sure. Cap resistance, of course, in sort of January, February. And then we had that strong close last week. Well, the previous week, sorry, where we dipped sort of down to sort of 4,100 or so, 4,103, but closed very strongly near its highs. And then finally, we had this break higher. Looks really positive to us, to be honest, and a push higher and closed near its highs as well. So the highs from last week, 42.90, and we closed at 42.82. So really positive close and above that zone, that strong zone of resistance that we had seen over the last few months at 4,200 or so. So that's now key support for us, and potentially we should push up towards then, say 43.25. That's the high from sort of spring, August last year. That's certainly the target for bulls in the near term. We've also got some fib levels actually at 43.11, so just above where we are now. That's probably initial sort of resistance before then that key level from August last year around 43.25. That's the S&P 500. If we look at the NASDAQ 100, just looking on the weekly, again, just consecutive weeks of gains, you can see, and we're quite kind of slightly overbought now on the weekly. You can see here the RSI above 70, so 72.32. Doesn't mean we can't go higher. If I just pull back, you can see often where we've sort of touched above 70, just a slight pullback and then gone again. So potentially just look for some possible retracement to this sort of stunning breakout higher. We highlighted previously 13,720 being a key level there. That's from again back in summer last year, but certainly we were looking for this break above the 100-week moving average. That was at 13,436, and then we've had a very strong burst higher, 2 consecutive strong bursts higher actually, taking us through then that mid-August level as well. So that will act as strong support for us. And then we've got some fib levels in here. We broke above that last week, so 14,349. That's a sort of big fib level. And in fact, if we for us on here just as a target, which will probably match the, yeah, just above these levels here. So the next fib level 13,411. Before that, we probably get these levels here around 15. Yeah, 15,411 is the fib, sorry, and then 15,161. 15,265. So 161, the first level for us, target for the bulls really. 15,000 really is your key level to the upside initially. That's the NASDAQ 100. Interesting, I think that as well, we got the Dow outperformance in the Dow finally on the day at least. a big move higher, over 2% higher. I think the Russell 2000, that had a 3.5% gain as well on Friday. So just showing you actually that breadth slightly getting wider, at least from what we've seen over the last few months, really. So decent move higher in the Dow. You can see the black line here is the 200-day moving average. So key sort of support level, you can see held prices a number of times over the last few weeks. And then we pushed above that quite strongly and above the light blue line, or blue line here is 50-day moving average, and then that gray line is the 100-day moving average. So pushed above there. But again, key for us, if we just pull back to the weekly, just blow that up slightly. Hopefully you can see that as big dotted line. We've highlighted this over many months. Goes back to, key level of resistance, really, 34,281 for us. Cap the upside over a number of months. And now potentially, if we can push above here, or push above towards that, then again, that may be key resistance to the upside. We're fine, decent momentum, obviously, after this move higher. Futures sort of pointing potentially to a build on this move. But again, 34,281 is key for us, key resistance for us to cap the upside in the Dow. Just want to point out probably the UK FTSE as well. Interesting sort of move last week. You can see we dipped down below the 50-week moving average, but then closed quite nicely, a bit lower from the previous week, but at least very close to the highs. And then we've had this move up today. Again, the thick blue line there, so black line, sorry, is the 200-day moving average. Dipped below there, acted as support, and then we pushed above it. So initial resistance probably will be sort of 50-day moving average, 7710, so 7,700 really, probably initial resistance to the upside for the FTSE 100. Okay, let's just quickly recap now last week's main event. So non-farm payrolls. I've got a graphic here. Hopefully these prove useful to you. So all the main numbers from this big employment report, the monthly employment report, of course, out of the US. Another blowout headline number, really, 339,000 jobs added in May, well above the 195 consensus expectations, and even the range, actually, the range was 100 to 250, so it blew that number out of the water, really. And also upward revisions to the past 2 months, they totaled 93,000, so really underscoring the strength of job creation, at least in the headline number. Interesting, I think, that contrast to that slightly, if we look at the detail, then the employment payrolls increase was at odds, actually, with a significant increase in the unemployment rate. Obviously, 3.7%, that jumped from 3.4%. 3.4% was a multi-decade low that we saw in January, then last month, and haven't seen that since around, I think, 1969. So a big jump up from that number, despite a stable participation rate. And we have to remember the latter is derived from the separate household survey, which pointed to a 310,000 net job loss in May. So just really interesting difference between the two surveys. While the number of Americans classifying themselves as unemployed rose 440,000. So as I said, there's a divergence between these two surveys. The jobless rate is calculated from the American households, while the payrolls number is generated from employers, from businesses. So you're kind of getting two conflicting stories here, and who is to believe in a way. Both show very different stories, very different messages about the direction of the US labor market in May. But certainly with wage growth continuing to soften, so that was at 0.3 month on month, down from 0.5%, and hours worked edged lower as well. So the market is kind of thinking that the June FOMC meeting will skip a rate hike and then hold rates at 5 to 5.25%. And that kind of is reinforced slightly by the falling wage growth numbers against this blowout headline number that we've seen. Excuse me. If I just pull you over to, or just check on then what we like to pull up, which is the CME Fed Watch tool. So if some of you guys don't know what this is, it's a great tool available online, the CME Fed Watch tool. So it analyzes the probability of FOMC rate moves for their upcoming meetings. And it basically uses Fed funds futures, so 30-day Fed funds futures, which then have been quite relied on to express market views as to the likelihood of changes in US monetary policy. So it's a great tool to visualize really both current and historical probabilities of various FOMC rate change outcomes for a given meeting date. So you can see here the next date, obviously next week, the 14th of June. And you can see then this idea of this FOMC skip narrative. So that's where they hold rates, 77% chance then that we hold rates at 5 to 5.25%, and just a sort of 23% chance that there is a rate hike coming, 25 basis points that would be. And then if we just skip, as it were, to the next meeting, which is the 26th of July, so you can see there now is around a 68% chance that rates move by 25 basis points, at least 25 basis points, probably I should say, at the meeting in July. So that's the idea of this skip theme taking hold. And certainly we had sort of a week-long last week, if you like, of dovish repositioning towards that outcome. If I just pull back, actually, you can see in June then, sort of 23% chance. Last week, that was given a 64% chance. So you can see that, as I say, that dovish repositioning of pricing out of the 25 basis point hike now, much less chance seen of that, was 64%, now 23%. And then you can see standing pat, if you like, a week ago, that was given a 35% chance. And then now 77% chance, similar to, or we're getting back to sort of a month ago, where rates were certainly thought to be unchanged, would be unchanged for this meeting next week. Certainly, we've had quite a few Fed officials bring us back to this position, and yeah, it seems likely that markets are now pricing in that occurrence. That was certainly due to the cooling off in wage inflation that we've seen from the NFP, and potentially then going forward, we have a hike in July. Just looking at the dollar then, or the reaction actually post the non-farm payrolls, then we obviously, as I've shown you, we had a decent jump higher in stocks, really just enjoying the underlying strength really in, or that labor market strength really, seeing an ongoing growth in the economy, underpinning really the resilience of the economy overall. Stocks, as we've said, had a decent move higher, and also then the DXY, the dollar closed at above 104 from 103.56. So a decent move higher in the dollar as well. That was all borne about by a decent move higher in treasury yields. And if I just actually pull up that chart, which we don't go into very often, but I always think it's useful. So the 2-year treasury yield chart, which I'll just find here, it's just a really good guide as to where Fed funds futures go, which is then obviously where potentially the dollar goes as well. So if we just, before we look at the dollar, you can see This is, yeah, as I say, 2-year Treasury chart. Don't want to get too much into it, but you can just see the consecutive days of gains, really. And then we pushed above these sort of simple day moving averages as well. And then after the pullback, sort of early last week, then we had that big decent move on Friday after non-farm payrolls, and then we're building on that today. So interesting now, just sort of on a technical basis, whether we can push up above sort of 4.6% or so on this 2-year Treasury yield, which then would certainly push, no doubt, the dollar higher. Just looking at the dollar then. This is the DXY chart, so it tracks against 6 of its biggest trading partners. The euro is by far the biggest weighting in this DXY index, around 56, 57%, I think, of the weighting. You can see sort of base building has built around sort of par 82. We've got that dotted line in there from back in February, the low there, tapped it a couple of times, looked as though we could be rolling over, and then we built this base and then pushed above the 50-day and 100-day moving average. And now potentially having paused slightly around 104, potentially moving above that now. Key then, initial resistance is last week's low at 104.69. And then if we do break above that, then just pulling this back, we've got a fib level somewhere. Long-term fib level actually at 105.01, you can see. And then potentially the thick black line acting as resistance at 105.56 if we do break above that. That sort of tallies probably with that level there, 105.88 or so. That's in the DXY. For this week then, just focusing on that, we've got the Fed's blackout period, of course, 10 days ahead of the FOMC meeting, so we won't hear from any Fed officials on the wires. This week's data, today we get ISM services report. I've mentioned initial jobless claims as well, as on Thursday. As for the services ISM, I think Bloomberg expecting a stronger report, 52.4 from 51.9 previously. The prices paid component in this report will be key, obviously, for inflation after a very strong print of 59.6 in April. Jobless claims then, that's on Thursday, likely to remain sub 250,000, but expected to rise ahead as more industries are announcing layoffs given the uncertain economic outlook. So that's really all we have in the US, really, second tier data, really, but should probably keep pricing and the DXY, an underpinning of support in the DXY, and then pricing for the Fed probably kept around that sort of 75-25 level, 75% chance, as I say, of being unchanged, and a sort of non-negligible chance of a rate hike. But certainly that skip theme is what's driving markets, or what markets are currently holding on to at the moment. Okay, just want to get into quickly the Eurozone data that we saw last week. So we've got this chart here just before we get on to those 2 central bank meetings this week, and we've got a couple of graphics for you just to highlight the main figures similar to that non-farm payroll graphic. Eurozone inflation, you can see this chart here just comparing it against the US in the pink, really, Eurozone in the blue, and then UK still very stubbornly high in the light blue there. So as I said, a lag, Eurozone still lagging the US, but still falling. That print last week confirmed the kind of disinflationary prints from the actual Eurozone country releases that we had in the previous days before Thursday's inflation Eurozone print. The HICP came in at 6.1%, so a sharp drop from 7% in April. And core inflation also slowed more than anticipated to 5.3% from 5.6% in April, and lower than forecasts of 5.5%. I think it's a lot actually for the core. It's down to there's an introduction actually of a German transport ticket, which is likely to be a key reason for the decline in the core. So I think economists are being slightly wary of over-interpreting this core print. And a detailed look at the breakdown showed that services eased to 5% from 5.2% in April. We also had non-energy industrial goods continuing to decline from the peak reached last year. Food eased, and then energy contributed again with a negative print of negative 1.7 year on year. All in then for ECB policymakers, they've kind of been out in force recently, stressing that higher rates are still appropriate and that 2024 rate cut bets will likely have to be adjusted. Actually speaking, just after that inflation data, ECB President Lagarde said inflation was too high. There is no clear evidence that underlying inflation had peaked. And that there was more ground to cover to bring interest rates to sufficiently restrictive levels. Highlight today then, probably in Europe this week, will be Lagarde speaking later, actually before the European Parliament. There may be obvious concerns that core inflation pressures could pick up again over the summer, and it seems kind of unlikely that Lagarde will U-turn from what she said, what I've just mentioned, with the ECB meeting only sort of 10 days away or so. And that comes, just remember, a day after the FOMC meeting, the ECB a day after the FOMC meeting next week. Markets still pricing in 2 more rate hikes before the peak. And that means then kind of the bar for a dovish surprise is still set quite low. But that said, of course, it would be a surprise if President Lagarde altered her recent hawkish rhetoric. As for data, recent data has highlighted that the German economy slid into recession in Q1 as dwindling global demand, especially from China, added to downside pressures on the industrial economy. This makes German data a key focus really in the week ahead. We've got April trade data due today. We've had already actually factory orders then out tomorrow and in industrial production on Wednesday. March data for those 2 industrial numbers was very weak and declined. So early indicators from Germany car manufacturers suggest that pressures have ramped up further in April, suggesting potentially further prints lower in the Q2 growth as well. Excuse me. Meanwhile, the disappointing Q1 GDP growth from Germany suggests that potentially the final print we get out of Eurozone GDP growth due on Thursday, that could also see a downward revision. That means that if the quarterly growth print goes into negative territory, this means the Eurozone is also potentially in a technical recession after, if you remember, Q4 GDP printed at negative 0.1 quarter on quarter. Okay, if we just look at then the euro dollar, the most popular traded currency in the world, of course. So you can see, if I just go to the weekly, actually, I just want to point out. Yeah, this doji candle here. So this is the weekly euro dollar chart. You can see last week's doji candle. It looked as though it was going to be slightly more bearish, but a doji sort of is a candle where we close near, well, we open and close near the same levels. You can see we opened at 107.17 last week, closed at 107.06, so pretty much very close together, and that's in the middle between the high, which was at 107.79, and the low, which is 106.35. So a doji kind of signals indecision, really, battle between the bulls and the bears, if you like. So interesting candle last week, but we are moving slightly lower today. You can see here, so sort of consolidation after these consecutive days of losses from having sort of poked above to a high of what we're 110.95 sort of late April. Try to stay above the 110.32 there, which is that high from sort of early February, got it on there, but we couldn't close really strongly above. And then we've just rolled over, sort of broken that near-term trend line support. And then we've got this longer-term trend line now, which we've broken as well. You can see there that dotted line sort of through these, the 50-day moving average and the 100-day moving average as well. So potentially 106.35 is a key level of support now in euro dollar. If we do sort of continue with this bearish momentum, and then 106 probably a key number really for support of euro dollar. But really interesting with that a load of German data potentially being weaker, then potentially looking at more downside in euro dollar this week. Okay, moving on to the main events for this week. We've got the RBA first. That's overnight tonight, UK time at least. We've got the chart here showing where we've sort of come from with the RBA. Slightly tough call, this one. Consensus expects the bank to keep rates actually unchanged at its meeting, with 22 out of 30 economists surveyed by Reuters thinking they'll be unchanged. Money markets pricing around a 70% probability for the cash rate to be maintained at its current level of 3.85%. So there's kind of a 30% chance or so of a 25 basis point hike. I've just got a graphic here with all the key numbers. Just thinking back then, the RBA surprised markets at last month's meeting. Remember, the RBA meets every month, not like some of the bigger other central banks, sort of 6-week, 8-week gap between those meetings. But the RBA meets every month. And last month, it delivered an unexpected rate increase to resume the policy tightening cycle. So that was its 11th hike in 12 meetings. While its language remains hawkish, as the board kind of expected that some further tightening of monetary policy will be needed, and remains resolute in its determination to return inflation to target, with the central bank really saying it would do what is necessary to achieve that. We also had the bank's quarterly statement of monetary policy, SOMA, also reverted to a more hawkish stance, which all came on the back of inflation weakening. That was then, but now, as you can see from this 6.8% figure, that fall in inflation has reversed. We've had, a monthly figure of 6.8% in April from 6.3% previously and 6.4% expected. So there is a reasonable argument for the bank to hike again this month. It's interesting. We've had, a lot of economists point to the quarterly CPI data being or carrying more weight than this monthly 6.8% figure. So potentially the RBA will wait for the next print for the quarterly number, which would be in August, and then it might respond to that second quarter new fresh CPI inflation print. Otherwise, other recent data releases have disappointed. Actually, you've got I've got in here 3.7% for the unemployment rate, so that ticked up from 3.5%. And we also had a surprise contraction actually in the employment change, and that increase retail sales data being relatively sluggish. So sort of contrasting picture really for the RBA to contend with. Obviously, if it sees inflation rising again, then it may be hard for the RBA to sit on the sidelines potentially at this meeting. And certainly, of course, inflation is well above the RBA's target range, which is, of course, 2 to 3%. I've actually got in there a 40% chance. I said 30%, I think. We're sort of 30 to 40%. I think it's changed since I put it in, and it's slightly lower than that 40% chance. For what it's worth, Goldman Sachs, they've raised their terminal rate, so their end rate forecast for the RBA to 4.35% from 4.1% they did have. Currently, we're at that 3.85%. So interesting there. They expect hikes at this meeting, 25 basis point hike at this meeting, and then also in July. Some others also wondering whether the RBA kind of just ties up this sort of slight odd number, if you like, of 3.85%, and they just raise rates by 15 basis points to 4%. They did that, if you remember, to kick off this cycle with that strange 15 basis point hike. And that's why, just to highlight then why we have the sort of 3.85. So some speculating whether they just increase by 0.15% to round it up to 4%, and then they reassess. We'll just check out then the Aussie, of course, kind of pushed around really by the dollar, certainly, and also, of course, Chinese data and the faltering recovery that we've seen in China. Interestingly, we broke out of this range you can see here, kind of long held range since sort of late February, early March, around sort of 68 to sort of 66, just below 66, tracking sideways, broke down below that end of May and dropped to sort of below 65, so 64.58. Couldn't really sustain that and pushed up then the end of last week in Aussie dollar, and we pushed back into that range actually. So interestingly, whether we hold the range again around sort of 66 or so, just below there, we're just below that at the moment, 65.79, or whether then 65 is key support really if we do break lower in Aussie dollar. That means potentially then they're obviously more dovish than markets expect, and they potentially say that they're on hold for longer than markets expect, of course, because there is a 25 basis point hike priced in for July, at least, if we don't go in the meeting overnight tonight. If we do get a more hawkish Aussie, then or RBA, certainly then we'll push above potentially 66.38 and then come up to sort of 66 or so resistance. 66.61 is the 50-day moving average you can see there, which tallies with the halfway point of the October rally, which is at sort of 65.63 or so. Oh, no, 66.63, sorry. So tallies with the 50-day moving average. So probably an important line of resistance within this bigger range if we are then to just track sideways again. Okay, that's Aussie dollar. Just moving on to the Bank of Canada, another sort of infographic for you. Hopefully these are proving useful. No questions at the moment, but please do ask any questions if you do have any. But the Bank of Canada, yes, similar slightly to the RBA. They announced on Wednesday anyway, no hike expected. Money markets kind of pricing in a probability of around, again, I think that I should have lifted that. It's probably around 30% now. So 70% chance that they stay on hold, 30% chance or so that they lift rates by 25 basis points, which would move them to 4.75%. Now we are fully priced for a hike by the September meeting. Recent months then, there has been expectation that the Bank of Canada would keep its policy rate unchanged through the whole of this year, actually. But then we've had stronger than expected GDP and also stronger than expected CPI metrics. You can see here 0.7% month on month, much higher than the 0.4% expected. And then GDP, as I said, better than expected, 3.1%. Higher than the 2.5% expected. We also have a buoyant housing market, also still strong job gains, and they actually come on Friday. So interestingly, after the Bank of Canada meeting, but still buoyant and certainly still a buoyant housing market has kind of lifted expectations for potentially a 25 basis point hike in this meeting. Minutes from the last Bank of Canada meeting kind of revealed that officials had discussed raising interest rates due to a concern about persistent inflation. And then, of course, we've had this resilient economic growth challenges in lowering inflation. Of course, then the risk of delaying action were the main arguments in supporting the case for a potential rate rise going forward. Again, remember that the Bank of Canada's inflation target is 2%, so they're wary of taking longer to get back to that due to certainly high services costs. As for the Canadian dollar, let's just look at that. So Canadian dollar actually has been the best G10 performing currency in the past month, actually, largely kind of thanks due to its high beta, so high correlation, of course, to the US economic narrative and a repricing as well of Canada's really buoyant domestic rate and growth story. These factors kind of overshadowed crude's or oil's subdued performance in May, and of course some risk sentiment instability. But you can see here, well, we've had a hawkish tone from the Bank of Canada, and potentially then we get a move lower. This would be in dollar CAD, so sort of kind of tracking sideways. We've got in here this dotted line, so sort of near-term trend line support. If we do break that, which is around 134, then obviously we're looking at these lows here around 133.14, and then potentially 133 on the nose, really, which is that April low there. Break that, and then certainly we look at this low from back in February around 132.62. If, of course, the Bank of Canada do sort of signal that they're on hold still, then this will push above. Dollar CAD will move higher, and we've probably got resistance around 135, actually major resistance, because there's confluence really of moving averages there, the 50-day, 100-day, and 200-day all sort of gathering around sort of 135. So that should potentially offer some resistance to dollar CAD and its upside. Okay, really good to have you on this week. A lot of new people on have joined the webinar, so really hope you can stay with us next week, same time, of course, and then please do follow us as well on social media, various channels, of course, and we do put out a daily commentary on the website, which has a look at the dollar, has a look at as well market thoughts and the day ahead in more detail, and then also a chart of the day. So please do follow us on social media and our daily commentary, which is on the website. Okay, good luck out there, and we will speak to you same time next week.